Welcome to Money and Freedom, the podcast about becoming financially free and building wealth for generations using stock market investing. Welcome back to the podcast. In this episode, we're going to talk about different investing myths that might hurt your return. Let's look at it. The first myth is that it's too risky to invest. This is a typical beginner's idea of investing. What do they really mean when they say it's too risky? Well, they are afraid that the stock price will drop. So we'll talk a little bit about how great volatility really is. And the short answer to if it's risky or not is it's not risky if you know what you're doing, if you follow the traffic rules of the stock market, and if you have some patience and the right mental attitude, because investing in stock, it's almost like a psychological game. It's a lot about having the right attitude, having the right, not just mindset, but not getting too upset, not getting caught up in your fears, not getting caught up in greed and fear. A little bit about me. I started investing around 2004, 2005, and as you can calculate, I was a few years in when the financial crisis hit the stock market. And obviously, my investments that were mainly in index funds, they suffered too. And I knew about value investing. I wasn't practicing value investing for the simple reason that I was a financial journalist and I was not allowed to invest in individual companies at that time. Well, like everybody else, I listened to the news while I was working in a newsroom, so it was following me everywhere. And the first day that stocks fell a lot, I was like, okay, yeah, well. And the second day they fell around 10%, I was like, okay, this is big, this is really big. And like everyone else, I could feel it as, pain in my stomach and a little bit of, but also I felt it like excitement because I knew that this could be really great news for my future financial wealth. So what did I do? I invested as much as I could. Every penny I could invest, I just invested it. And how did that work out? Well, the financial crisis overall was, if you look at an overview of the different stock market crashes in history, you'll see that it was the third worst one. Stocks dropped around 54% at the time from October 2007 until March 2009. And I can tell you, because I was in it, that's a pretty long time. So we've got the fall 2007, and next fall it's still 2008. It's still pretty bad. We have to go to the spring, so it's 1.5 years. It's pretty a long time. It feels like a long time. But it could have gotten much worse. The worst stock market crash we have had was after around 1929. And it took actually from September 1929 until July 1932. That's around 3 years. And how much did stocks drop then? Almost 90%. It's almost like a whole eradication. It's 89.2% to be exact. 34 months. That's a lot of months. Anyway, so how did my particular investments go? Well, I was in the main indexes like Dow Jones and Standard & Poor's 500, and you can Google it or look it up on your trading platform, and you can see that, yes, they did fall, and they did fall quite a lot. But at the bottom here, so if we take Dow Jones, it fell from around, it's hard to see, 15,000 down to 7,500. So that's half of it gone. But within a few years, if you're investing at the bottom of that crash, within a few years, what you're investing then will have doubled. Already in around 2013, it's around double already in 2013. And, in the beginning of 2025, it was at 44,000. So from 7,500 to 44,000. The same thing with, if you look at Standard & Poor 500, it dropped. It dropped from around 1,600 to 770. But again, within a few years, it had doubled in value. Same story, and it just, it's been a pretty good ride as well for many years. So I would say, instead of saying that it's risky to invest, I would like you to think that volatility in the stock market creates opportunities for you. If you actually look at it, most people, when they look at, for example, when I have noticed this, when I teach people, they look at investing in a fund, they will look at the graph and see how it's done historically. And they really like when it goes up in a very consistent way, and they will think, this is a good investment. So let's say you have two funds. Oh, it could be a stock, it doesn't matter. It goes from 100 to 110, to 120, to 130, to 140. That sounds like a great investment, doesn't it? And in this example I'm going to give you right now, you're going to use dollar cost averaging, which means you're just going to invest the same amount every period. So if we're saying that this is every year, that it goes from 100 to 110, well, every year you're investing the same. So now we're just going to say you're investing 1,000, whatever, dollars, euros, bananas, doesn't matter. In the other fund, which most people would say, that's a horrible investment. This goes from 100 in the first year, then it drops to 60. Ouch. It stays at 60. Then it rises to 140. Yay! That's where the other one ends, but it drops back to 100. That doesn't look like a great investment, does it? Well, you can plot this into, you can calculate it, plot it into a spreadsheet and figure out, okay, so how many shares do you get? So, 1,000, and it costs 100, you get 10 shares, and so on. You just calculate it. And I can tell you that the worst of these investments is the one that goes up steadily, the one that goes from 100 to 110. It's not a bad investment, but the other one would do better, because in the years that the stock will fall, you will get a lot more shares. So the thinking here is, okay, the stock price dropped, I'll buy more. Of course, you always have to look at what you're investing in. You can't just buy it because it drops, right? That was like, that's the big red button, not the way to do it. But the idea here is volatility creates opportunities. So it's just great news. Myth number 2 is the idea that you have to be rich or very lucky to become rich with stocks, meaning you already have to have a lot of money in order to invest in stocks. And I hear this a lot. People have the idea that you can't just invest a little. They think it's not even worth it. So they think you need to have something extraordinary already, some inheritance, or just be extremely lucky in order for it to work for you. And that's simply not true. The short version here is you just need to trust the power of compounding. And I'll tell you a little story. The story about chess. So when chess was invented, there was this wise man who sold it to a king. And I don't know if this story is real. It's a myth maybe, but it's a good point. It has a really good point. So he told the king who wanted to buy chess, the game, he said, you can buy it, but the price is, you have to pay me in rice. So, how chess has a lot of squares. I think it's 64 squares. And he said, in the first square, there has to be 1 grain of rice. In the second, 2. In the third, we double it every time. So 1, 2, 4, 8, 16, and so on. And the king thought, oh, he just wants a little bit of rice. That's perfect. Yeah, he just said yes. He didn't even calculate it or consider it. But it became so much rice because it was doubled around 64 times. it became 18 quintillions grains of rice. I think I've never said quintillions in my life before. That's a very huge number. And it was more than the world production at the time. So the new sentence you have to say is that you have to use compounding to become rich. And of course, we can't expect our money to double every year. So we're not going to reach anything close to quintillions, but we can, if we do it right, we can expect a good average return. And of course, I can't promise you anything at all specific, but I can tell you the school that I belong to, value investing, a lot of the most famous value investors get around 15% average, of course, and they have down years too. But what do? They buy more, like we just talked about. If you have 15%, that's going to be a double every fifth year. That's not bad at all. Myth number 3 is you have to be very intelligent or very educated to be good at investing. And I would say, well, you actually just have to know how the traffic works and follow the traffic rules. It's a good thing to be smart. Smart is very different from intelligent. With smart, I mean emotionally intelligent, almost like, and just like smart about it, instead of having a very, very high IQ. And here we are touching on a different related myth, which is that the market is efficient. These two are tied together because the fact that the market isn't efficient means that you don't have to have a very high IQ or be super intelligent in order to make a good return on the stock market. So let's talk a little bit about this idea. Is the market efficient, yes or no? If you take any stock chart, basically anything, you can take Dow Jones, you can look it up. What did it do since the inception? What has it done for more than 100 years? Well, of course, I mean, you probably know already now that we had some major events in 1929. And of course, that's like a huge drop on the chart. You have the financial crisis. That's a huge drop. You have the the dot-com bubble. In Danish, it's called IT. Sorry about that. You have the dot-com bubble. And so on. And so it goes up and it falls and goes. So it doesn't look, if you look at it, it doesn't look very efficient. What about individual companies? You can look up any company. For example, go to Yahoo Finance, look up any company, and look at the 52-week range. What does this mean? It means where has the stock developed within a year, within 52 weeks. And any company will move a lot in a range. For example, I just looked up Amazon, and it says it's moved from 152, rounding up, 152 to 243. So let's just think. So if the stock market was efficient, would it move that much? Does the value inside the company really move that much in a year? And the answer is no, it doesn't. The stock price is not always related to the truth, to the real value in the company. Let's look up another one. Let's look up Apple, for example. And the 52-week range here would be 164 to 260. That's a wide range. That's what Mr. Market, and we'll talk more about Mr. Market in a second, that's what the market believes that the value of this company is. And that's not efficient. That is not efficient at all. Why is it not efficient? And now I'm going to introduce you to Mr. Market. Mr. Market is something that Ben Graham wrote about in chapter 3 of The Intelligent Investor. He describes Mr. Market as a person, and he says, imagine that you owned a company with another person, and this person is behaving like Mr. Market. So we'll call him Mr. Market now. And let's say that there's a profit every year of 1 million. I'm just going to say completely random number that are easy to remember and that are very round. The whole firm is worth 10 millions, whatever, it doesn't matter. And every day your partner, he gets up in the morning, he considers, and you're owning 50% each, and he considers if he should buy your share or sell his own share. Every day, he gets up, it's one of the first things he thinks about. Shall I sell my share or shall I buy the other part? What shall I do? And now this Mr. Market guy is super moody. So if the sun is shining, he's in a good mood. His wife made him coffee and a delicious breakfast and, everything sounds about right. Well, so he wakes up and the sun is shining. It's been a wonderful day. His wife made him a nice coffee and, it's the right tune on the radio. And he's in a good mood. So he's ready to buy your share for 20 million, even though the whole company is only worth 10 million. And other days, he is in a crappy mood. He didn't sleep well. It's pouring down outside. His wife is not even there. And now he is ready to sell his share of the company for 1 million, even though the whole company is worth 10 million, so that should be worth 5 million. And why is it like that? And this is basically, well, not from day to day, but, over time, this is how Mr. Market reacts. And why is that? Why is the market behaving like that? That's because the market is not a machine. The market is like a giant auction. And you know how people react on an auction? They want something, and then they get scared that they get FOMO, they get scared they're going to miss out on it, and then they start bidding it up. And that's actually what happens. The market consists of people, and people have emotions. And some of these emotions are really like primal. And the funny thing about money is that it really connects to these primal emotions that we have. Because money, if you think about it, will provide housing, food, school for children, transport, car, whatever, everything. Everything is related to money. So we feel when something is up with money, if we feel threatened money-wise, we feel like our whole life is threatened. That's why in 1929, you had people jumping off buildings because the stock market was crashing. Because for them, it felt like everything was crashing. The efficient market hypothesis, which is the dominant way of viewing the stock market, believes that the market is always efficient. And this is the way that, when you go to the bank, that's how they're thinking. They're thinking it's an efficient market. At most business schools, the professor will be thinking in terms of the efficient market hypothesis. Most podcast hosts will, your neighbor probably. Everyone, almost, it's like the majority of stock market investors, they think the market is efficient. And the logic here is, if the market is efficient, well, in that case, if it works like a very good machine, that's everything being calculated, well, in that case, the prices would always be right. If the prices are always right, you should just be invested. You should be fully invested and just spread out so you're diversified and that's it. But is it really efficient? If you think about it, do people react in a rational way? And of course, we know that they don't. If you think about it, you've got the financial crisis, 1929, you've got the dot-com bubble. And if it's a bucket and there are holes in it, it's not a good bucket. It cannot be efficient and not efficient at the same time. Well, in a way it can, but we'll get back to that. And the idea that it's not efficient, that's what you're using to your advantage. You're using the volatility to your advantage. But if you don't really relate to the fact if it's efficient or not, and you're just investing as if the market is efficient. Oh my God, I'm saying efficient a lot, but that's okay. Then it would feel very, very unsafe, because I think subconsciously you will know this is not efficient. Even though they tell you, yeah, just invest in everything, you kind of know this is not a good idea. You'll be caught and you'll get really, really scared when Mr. Market does his thing and he wakes up and it's raining and he's not in a good mood. So who's right? You've got these two sides. value investors saying the market's not efficient, and the efficient market hypothesis saying it is. Well, the truth is that sometimes it actually is kind of efficient, but it has periods where it's extremely inefficient. So meaning that you'll have times where we're in bubble territory, like during the dot-com bubble and the everything bubble that we've experienced for some years now. And then it dips and it crashes, and then it's not efficient because people are really, really scared. But there are long periods in history where things will even out to a reasonable level. This means that, and this is actually why value investing works. If it was always completely inefficient, it would also be difficult. But so you are looking for these pockets where it's not efficient, and investing when the stock price of the company dips below the value inside the company. And then you wait, because at some point, the market will realize, and even Mr. Market will realize, we made a mistake. This is probably worth more. And that is what we're trusting. So in a way, we're trusting that it's kind of a little bit efficient sometimes. And the thing is, because most people think, well, in that case, if that's how it works, then I should just wait for the crash and then invest. And I'm saying no, because you're going to miss out on so many opportunities. Because it's not just, the whole market crashing and gets up again. There are many little bubbles and crashes inside the big stock market. So there will be companies that go through an event. There will always be something that are affected by the fear of people. It will happen all the time. So there are always opportunities in the market. And this is what you have to take advantage of. To take advantage of when Mr. Market is in a bad mood and it's raining, to buy some. And when the sun is shining and he's had such a wonderful breakfast with his wife, maybe you can sell it back to him. So being a good investor is a lot about having patience, waiting out these periods. And as I told you in the beginning, it can take 1.5 years and even more, 3 years with 1929. And it's about being emotionally intelligent about it. And how do you know when it's a good time to invest? And this is something that we can calculate. My favorite method is owner earnings, which is a method that came from Warren Buffett. And I have an ebook where you can learn it, and I'll link below in the notes. And so there are other ways to calculate, but this is an easy one to learn. And then you invest when the stock price falls below what you've calculated. And in most cases, that will turn out quite well, but only if you also look at the company itself. You can't invest in anything, and just calculate all the stocks in the market and just pick you could, but that's a different way of investing than I do. I think it's very, very important to look at what kind of company, and that's where you have to use the checklist. Because price is not enough. Price below value is not enough. You need quality. This is the concept. I've talked about that before. It's the concept, a wonderful company. And here comes the quote again from Charlie Munger. Never forget this quote. It's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. And the idea of a wonderful business means a business where we're quite sure, and you can never be 100% sure, but we're quite sure that it has a good future, that there will be growth, and there will be more products sold within the next 10 years. Like Warren Buffett says, he really likes to invest in things where he ideally could buy the stock and then just go sit on an island and wait 10 years because he feels so safe that it will be fine, without him looking at the stock or looking at the company all the time. So how do you know if it's a wonderful company? Of course, you have to take it through a checklist. And in a previous podcast, I did go through the checklist in detail. The next myth that we want to kill is the myth that you have to time the market. I touched upon it a little bit before when I said that some people think you just have to wait until there's another financial crisis or big stock market crash, and then they'll invest. They'll just sit with their cash and wait. But that's not a great way either. And it's a very strong idea right now because we had a few years that were good. 23 and 24 were quite good. So now people are thinking, ooh, this looks nasty. I should probably just sell everything and wait and then buy at the bottom. This is probably going to be a tough ride. But again, you have to look at the companies. And to be more specific, you have to think like an owner. If you go in and out and, I think there's going to be a crash, I think, this is a good time, it's going to ruin it for you. It's about picking the right companies, and the right time doesn't have anything to do with the overall market. The right time is when the stock price falls below the value of that particular company. And if you did the job of taking through a checklist and it showed up that it was a wonderful company, then you just stay put. I mean, you should probably follow a little bit what's going on, but just stay put, be cool about it. Don't take it in and out because you think there's going to be a stock market crash. So I'll quickly go through the checklist, but there's another podcast where I went through it in more details. So what you want to do is, first of all, you want to skim it. And before I do it, I just want to say I'm going to put a link because you can download this as a one-pager. So I'll put a link below where you can download the checklist. So the 12 questions that I think you should ask is, first you skim the company. And the question you're asking is, are the company's sales, profits, and equity growing? Some other things you can look at too, but these are the most important. You want to figure out, is this a company with growth? The second one is, do I understand it? This is circle of competence. And the third one is checking the values. Do the values of this company and the management align with my values? This is also very important. The fourth one is this the best in class? And this is where you're comparing it with the peers. Because, you might fall in love with a particular company, but you want the best of those companies because the best of those companies might be the one with the best competitive advantages. And that's the next one. Does it have a moat? A moat that will protect it from the competitors, that will make sure that the clients are staying or the customers are staying with them and not just jumping to a better offer. So there's a moat they have to trespass in order to switch. And next one is trends. What are the trends? Will there be an increased demand for this kind of product or service in the future? Then we look at risk. Are there any risks, systemic risks, or anything from governments heading their way? Debt, we will check their debt. This is one of the warnings, things that, we don't want to invest in things that might go bankrupt. So we check how high is the debt in this company. We like them to be able to pay it back within 3 years with cash flow. Then we check what the insiders are doing. And what we're really looking for here are two things. First of all, we want the most important insiders to have the same interests as we do. We would really like if they own a significant part of the company. So they need to have shares in the company. How do you know if it's significant? Well, if it's the CEO, you look at how much money is he earning every year and how many years. It should be years of salary put into the company he's working for. So he thinks like an owner as well. The other thing we are looking for is, are they selling? So if we see that any of the key insiders are selling a lot of stocks of the company they're working for and the company they have special knowledge of, that could be a really bad sign. It could be a sign that they have insider knowledge that something is completely wrong. And the next thing we check are the gurus. That means the other value investors. Do any of them own stocks in it? If they don't, maybe it's not a great investment. And then we check if the stock price is, of course, we check if the stock price is below the value. And if that's the case, we also have to think about why is that? What is the thing that this company is going through? Is there some kind of event that is threatening it? Or is it an event that doesn't really matter anyway? So those are the things that we look for. And what we really want to get at is we want to invest with peace of mind. Wouldn't that be great? And of course, we want a nice return as well. But investing and feeling cool about it. And how do you actually do that? Well, there's just one way, if you ask me. It's doing the research. And if you don't do the research, if you just invest in a random way, like, oh, I heard this is great, or, my neighbor said he's investing in this, I'll copy him, that's going to feel horrible when stocks fall. And also, it might be that if you're investing in passively, because then you're investing with the idea that the market is efficient, that might also feel horrible. So the best way, if you ask me, is to invest, do the research, take the company through that checklist. And if something happens and you're investing in companies, then look at what is it that's happening and look at reality. Don't just sit and look at the stock like it's a goldfish and get scared about how the goldfish is moving. Look at reality. Because in a way, the way that the stock price moves isn't always reality. It's almost like, when these things go crazy, it's a bit like fiction. So reality is the company and what the company produces. Is that really going to be affected? If it's, if they're selling, if it's Coca-Cola selling a drink, then you have to really think things through. Let's take an example. The sales of Cokes affected by financial crisis? Or would they, you had the lockdowns, would people drink less Cokes if there's a lockdown, maybe if they go less out, but wouldn't they just buy them and drink them at home? Or it could be like an investment like Netflix. Would people give up Netflix because there are tariffs? Or would people give up Netflix because there's a lockdown? I mean, think it through. And that makes you feel a lot more calm. And if you reach the conclusion, well, actually, it doesn't make sense that they should be invested. And if it's still a wonderful company, you just stay put and you just stay cool about it. And the important thing here is to keep on learning, keep on listening to this podcast, of course, keep on reading books, take my course. I have a course that can teach you more. And remember that the best investors, they actually do learn a lot. They read a lot. We know that Buffett and Munger, who's unfortunately dead, and Warren Buffett, they read a book a day. And of course, like I said before, important to always distinguish between price and value. And remember that even though the stock price drops, it doesn't mean that anything is wrong. Volatility is a great opportunity. And that's it for today. If you enjoyed this podcast, please like, share, and review it because it really helps the podcast grow. And feel free to, if you have a question, ask me on LinkedIn or X. My handle is my first name, Beile, B-E-I-L-E. Please remember, what we share on Money and Freedom is for education and entertainment only. The opinions you hear from me or my guests are not investment advice. Always do your own research or speak to a professional before making any decisions.